Hi there, and welcome to the Property Wealth Podcast. We're really excited to have you with us today.
Absolutely. It's great to be here, Sarah.
Today we're diving into a really interesting trend that's been gaining a lot of traction lately. Build-to-rent communities.
Right. It's not just a buzzword anymore. It's becoming a viable strategy for investors, especially for those looking to build long-term wealth.
Exactly. We'll explore what build-to-rent actually means, how it's different from traditional rental properties, and why it could be a smart move for investors over 40.
And we'll also touch on the potential risks and rewards, right? It's crucial to look at both sides.
Yeah, and we'll share some real examples of successful build-to-rent projects so you can get a sense of what's out there.
Plus, we'll discuss how to evaluate these opportunities in your local market.
So if you're curious about how build-to-rent communities could fit into your real estate strategy, stick around.
I think it'll be a really insightful conversation, and I'm looking forward to diving in.
Let's get started. So Mike, can you break down what build-to-rent communities are and how they differ from traditional rental options?
So, Sarah, the whole idea of build-to-rent communities is really resonating now, especially for folks over 40.
Absolutely, Mike. I mean, many people in that age group are thinking about their retirement timelines, right?
Exactly. With retirement not too far off, having a solid plan in place is crucial. Build-to-rent communities can provide a steady income stream, which is vital for those planning to retire soon.
Yeah, and let's not forget about inflation. It's been creeping up, and it's something we all need to consider.
Right. Rental income can be a great hedge against inflation. As rents rise, so does your income, which helps maintain your purchasing power.
I've heard stories from investors who bought into these communities a few years ago. They're seeing their cash flow increase as demand for rental properties goes up.
I remember one investor telling me about a build-to-rent community they invested in a couple of years back, right before the pandemic hit. They were worried at first, but the demand only grew. They ended up with a great return on their investment.
That's so encouraging. It really shows how resilient this strategy can be, even in uncertain times.
Yeah, and with the current economic trends, many people are moving away from home ownership. Whether it's due to lifestyle changes, job mobility, or just wanting to avoid the hassles of maintenance.
Definitely. I think there's a growing acceptance of renting as a long-term lifestyle choice.
Exactly. And for investors, this shift means that build-to-rent communities can often fill a gap in the market, especially in urban areas where housing is tight.
I spoke with a couple who decided to invest in a build-to-rent community after their kids moved out. They wanted to create a legacy for their family, something that could provide stability for their kids and grandkids.
That's a great point. It's not just about making money. It's about financial security and legacy building. They were thinking ahead, wanting to ensure their family had something tangible to rely on.
And the emotional side of that is huge, right? Knowing that you've set up something that can secure your family's future.
Absolutely. It can offer peace of mind, especially as we face economic uncertainties and changes in the job market.
And with wealth transfer becoming such a hot topic, it's interesting to think about how real estate can play a role in that.
For sure. Many people are looking at how to pass on wealth to their children in a way that's sustainable. Real estate can be a fantastic vehicle for that.
Right, and build-to-rent communities often provide a more hands-off approach for investors who may not want to manage multiple properties.
Exactly. For those over 40, it can be a way to diversify their portfolio without the usual headaches of property management.
I think about all the people who feel overwhelmed by the idea of being a landlord. This option can really ease that burden.
Yes, and let's not forget about the social aspect of these communities. They often foster a sense of belonging. People want to live in places where they feel connected.
That's a great observation, Mike. It's more than just a roof over your head. It's about being part of a community.
Right, and as more people value that connection, the demand for these types of properties is likely to grow.
It makes you think about how real estate isn't just an investment. It's also about lifestyle.
Exactly. And for those of us over 40, embracing these trends can help us navigate the economic landscape and create opportunities for ourselves and our families.
Well, it sounds like there's a lot of potential here, especially in terms of building wealth and securing our financial futures.
For sure. And with the right strategies, it can be a game changer.
That leads us perfectly into discussing those core strategies.
So let's dive into some of those core strategies and rules of thumb that can really help when evaluating build-to-rent communities, yeah?
Yeah, absolutely. I think starting with something like the 1% rule is a good way to go. It's a simple guideline that can help investors quickly assess whether a property is worth pursuing.
Right. The 1% rule suggests that your monthly rent should be at least 1% of the purchase price. So if you're looking at a property that's priced at, say, $200,000, you'd want to see it renting for around $2,000 a month.
Exactly! And that's a quick way to gauge cash flow potential. But, it's important to remember that this is just a starting point, right?
For sure. It's not a hard and fast rule, but more of a guideline. And when you're looking at build-to-rent communities, you also want to consider the overall market conditions too.
Right, like, what's the demand in that area? If it's a growing neighborhood with lots of jobs coming in, you might be able to push rents higher than what the 1% rule suggests.
Exactly, and that leads us into the 50% rule, which is another great one to keep in mind. This rule states that about 50% of your rental income will go towards operating expenses.
So, if you're bringing in $2,000 a month in rent, you'd want to estimate about $1,000 for expenses, right?
Yep, and that covers things like property management fees, maintenance, property taxes, all of that. It's a good way to ensure you're not overestimating your cash flow.
And when you're looking at build-to-rent options, you might even want to account for a little extra if the community has shared amenities, like a gym or a pool. Those can increase your operating costs.
Absolutely. Those amenities can attract tenants, but they can also add to the expenses, so it's a balancing act. Now, another key concept in evaluating these communities is the cap rate or capitalization rate.
Right, the cap rate gives you an idea of the potential return on investment. It's calculated by taking the net operating income and dividing it by the property purchase price.
So if a property has a net operating income of $20,000 and you bought it for $200,000, your cap rate would be 10%.
That's a solid cap rate. Generally, a higher cap rate indicates a better return, but it might also mean more risk. So it's important to consider that alongside other factors.
Exactly, and when you're looking at build-to-rent communities, you might find that the cap rates can vary significantly based on location, property type, and even the current market climate.
That makes sense. Let's not forget about financing options, too. There are different ways to finance these types of investments.
Right. Traditional mortgages are an option, but some investors might consider using a portfolio loan if they already have multiple properties. This can sometimes offer more flexibility.
And then there are hard money loans, which can be useful if you're looking to flip or develop quickly. But those come with higher interest rates, right?
Yes, definitely. Hard money can be a double-edged sword. It offers quick access to cash, but often at a cost. It's essential to have a solid exit strategy if you go that route.
Speaking of exit strategies, what about the different types of properties or markets to consider for build-to-rent investments?
Well, single-family homes can be a great option, especially in high-demand areas. But you might also want to look at multifamily units, as they can provide more units and potentially lower vacancy rates.
And then there's the consideration of urban versus suburban areas. Urban areas might have higher demand, but also come with higher price tags.
Right, and in suburban markets, you may find more value and potential for appreciation over time, especially as people seek more space.
Yeah, and don't forget about the importance of local demographics, understanding the target market. Are they young professionals, families, retirees? Can really help shape what kind of properties to invest in.
Absolutely. Tailoring your investment strategy to the local demographic can lead to better tenant retention and reduced vacancy rates.
So when evaluating these investments, it's good to have a checklist, right? Like key factors to assess.
Definitely. Start with location. Look at job growth, schools, amenities. Then, analyze the financials, rental income potential, operating expenses, and financing options.
And don't overlook the physical condition of the properties either. It's crucial to assess any repairs or renovations that might be needed before renting out.
For sure. Getting an inspection can save you from unexpected costs down the line. You want to go in with your eyes wide open, you know?
Yeah, and maybe even speaking to local property managers can give you insights into tenant needs and what the market is really like.
That's a smart move. They can help you understand rental rates and what amenities might attract tenants.
So all these strategies and guidelines are super helpful, but what about common pitfalls?
That's a great point. It's easy to get swept up in the excitement of a new investment and overlook some critical details.
Right. So let's talk about that next. What to watch out for when diving into build-to-rent communities.
So let's dive into some of those common pitfalls, shall we? I think one of the biggest mistakes that new investors make is over-leveraging. Borrowing too much compared to what they can actually afford.
Absolutely, Mike. It's like they see the potential returns and just go all in without really thinking it through.
Right, and then when the market shifts or if they encounter unexpected expenses, they can find themselves in a really tight spot. I remember a client of mine. Let's call him Tom. He bought a couple of properties, thinking he'd just rent them out and cash flow would be no problem. But he stretched his finances too thin.
Oh no. What happened?
Well, one of the properties had a major plumbing issue right after he bought it. It ended up costing him thousands to fix. And because he was already over-leveraged, he couldn't handle that expense. He had to scramble to find funds, and it really put him in a difficult position.
That's such a tough lesson. It sounds like a classic case of not having enough cash reserves.
Exactly. Cash flow is so crucial. If you're not keeping a close eye on your income versus expenses, it can lead to all sorts of trouble. I've also seen investors overlook the importance of screening tenants properly.
Oh gosh, yes. That's a huge one. Bad tenants can really drain your resources.
Definitely. I had another client. Let's call her Lisa. She was so eager to fill her rental that she accepted the first applicant without doing a thorough background check.
Yikes, what happened?
Well, it turned out that the tenant had a history of late payments and, let's just say a rather messy lifestyle. They didn't take care of the property, and Lisa ended up spending more on repairs than she received in rent.
That's so frustrating. It's like a double whammy. Not only do you lose rent, but you also have to spend money fixing things.
Exactly. It's really important to take your time and find reliable tenants. And that brings us to another point, ignoring cash flow.
Right. I think a lot of people get caught up in the excitement of property appreciation and forget about the day-to-day expenses.
Yes, and it can really bite you if you're not careful. I know a couple who bought a property thinking they'd just ride the wave of appreciation, but they didn't factor in things like property management fees, maintenance costs, and even vacancies.
It's easy to miss those, isn't it?
It really is. And when they finally sold, they realized they had barely broken, even after all those costs. They were heartbroken.
That's such a tough realization. So what do you think is the best way to avoid these pitfalls?
Well, a good practice is to do a thorough analysis before you buy, like really digging into the numbers. Make sure you're accounting for all expenses, not just the mortgage.
Right, and I think having a solid cash reserve is key. You don't want to be scrambling for money in emergencies.
Exactly. And it's also about timing. A lot of investors try to time the market, thinking they can buy low and sell high, but that often leads to missed opportunities.
Yeah, I've seen that too. It's like they wait, and then the perfect property slips away because they're too hesitant.
Precisely. I had a friend who spent years trying to time his investments, and in the end, he missed a fantastic opportunity just because he was waiting for a better deal.
It's such a common mentality. It's like paralysis by analysis, right?
Exactly. Sometimes you just have to take the leap, but do it with a well-informed plan. And then there are hidden costs.
Oh, those pesky hidden costs. They can really sneak up on you if you're not paying attention.
Right. I had a client who bought a property thinking it was in great condition, but after closing, they found out there were significant HOA fees that had not been disclosed, and the roof needed repairs.
That's so frustrating. It's like the costs just keep piling up.
Yeah, and that can really eat into your profit margins. So the key is to do your due diligence. Always ask for full disclosures, and don't be afraid to dig deeper.
And I think it's also helpful to work with professionals who know the market well. They can help you spot red flags early on.
Absolutely. A good real estate agent, an inspector, and even a financial advisor can provide valuable insights that might save you from making costly mistakes.
So what would you say are some red flags to look out for during the buying process?
Well, if a property has been on the market for a long time, that can be a sign. It might mean there's something wrong with it, or the price is just not right.
That's a good point. And what about the condition of the property itself?
Yeah, if you see signs of neglect, like peeling paint or overgrown landscaping, those could indicate bigger problems. And you should definitely pay attention to the financials. If the seller is vague about expenses, that's a major red flag.
So it really comes down to being thorough and asking the right questions, doesn't it?
Exactly. And if something feels off, trust your instincts. There are always other opportunities out there.
Well, it sounds like the key takeaway is to be informed, patient, and prepared.
Right. And if you find yourself in a tricky situation, remember that it's not the end of the road. You can always pivot, learn from the experience, and come back stronger.
That's such a great mindset to have. So what do you think are the next steps for someone who's feeling a little overwhelmed after hearing this?
Well, first, take a deep breath, and then maybe start by evaluating your current situation. Look at your finances, set aside a cash reserve, and consider seeking advice from professionals.
That sounds like a solid plan. And maybe even connect with other investors to share experiences?
Absolutely. Networking can be invaluable. You'll find that many people have been through similar challenges and can offer insights that can really help you avoid those pitfalls.
Great advice, Mike. I think that's a perfect way to wrap up this part of our discussion.
All right, so let's dive right into some immediate steps that our listeners can take today to get started with build-to-rent investing.
Yeah, I think that's super important. It can feel overwhelming, but really, it's all about taking those first steps, right?
Exactly. So one of the first things I'd recommend is to get familiar with your local market. Understanding what's happening in your area is key. You could start by using sites like Zillow or even the local MLS just to see what properties are available and get a sense of rental prices.
That makes sense. And it's not just about looking at listings, right? It's about understanding the trends.
Right. You want to keep an eye on things like vacancy rates, average rent prices, and even what amenities are most desirable. This can really shape your investment strategy.
Speaking of strategy, what about analyzing deals? Do you have any tools you'd recommend for that?
Absolutely. Tools like the BiggerPockets calculator or deal check can be really helpful. They allow you to crunch the numbers quickly and see if a property aligns with your investment goals.
Those tools are great. I know a lot of people can get stuck in analysis paralysis, though.
Yeah, that's a common challenge. But starting with one deal analysis a week can help build your confidence. You don't have to overthink it. Just pick a property, run the numbers, and learn from it.
And it's okay if it doesn't feel perfect right away, right? It's all about learning and improving.
Exactly. And another useful tool is Rentometer. It helps you compare rents in your area, which is essential for determining if a property is priced right.
I love that. It gives you a clearer picture of the market and can help you make a more informed decision.
Definitely. And let's not forget about networking. Joining a local real estate meetup can provide invaluable insights and connections.
Oh, for sure. Connecting with others can really inspire you and keep you motivated. Plus, you can learn from their experiences.
And if you're not sure where to find meetups, meetup.com is a great resource. You can search for real estate groups in your area, and it's a good way to meet like-minded individuals.
That's a really practical tip. And for those who might not be able to attend in person, are there online communities they can join?
Yes, there are plenty of online forums and groups, like on BiggerPockets or even Facebook groups, focused on real estate investing. Just engaging with others can spark new ideas.
And what about books or podcasts? Any recommendations to dive deeper into this topic?
Absolutely. I'd suggest checking out books like The Book on Rental Property Investing by Brandon Turner. It breaks things down in a very approachable way. And for podcasts, BiggerPockets Podcast is a fantastic resource.
That's a solid list. And for someone who might feel overwhelmed, what habits can they start small?
Well, I'd say start by committing to analyzing just one deal a week. And maybe set a goal to read a chapter from a real estate book each week, too. It doesn't have to be a huge time commitment.
That sounds doable. Small, consistent actions can lead to big changes over time.
Exactly. And keep a journal of your learnings, too. Writing things down can help solidify your understanding and track your progress.
Great point. Plus, it'll give you something to look back on and see how far you've come.
And if you ever feel stuck, remember to reach out to your network. Don't hesitate to ask questions. Most folks are happy to share their experiences.
That's so true. And it's all about building those relationships and learning from each other.
Right. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. Well, Sarah, we've covered some really interesting ground today. I think one of the biggest takeaways has to be the appeal of build-to-rent communities for investors over 40. They really offer that balance of steady income and lower maintenance compared to traditional rental properties.
Absolutely, Mike. And then there's the growing demand for these types of properties, with more people looking for flexibility in their living situations. It's definitely a trend to keep an eye on.
Right, and we can't forget about the importance of location. Investing in these communities in areas with strong job growth and amenities can really maximize returns.
Yes, and the whole concept of community living. It's not just about the houses, but creating a lifestyle that attracts renters. That's a game changer, I think.
Plus, the potential for long-term appreciation is something we shouldn't overlook. It's all about playing the long game, isn't it?
Exactly. Building wealth through real estate isn't a sprint. It's more of a marathon. And with the right strategies, you can truly set yourself up for financial freedom.
For sure. So listeners, if you found value in today's discussion, consider liking, subscribing, and letting us know your biggest takeaway or any questions you might have in the comments.
And don't forget to share this episode with someone over 40 who's thinking about investing in property. You never know who might need a little nudge.
Next time, we're diving into something really exciting. Accessory dwelling units, or ADUs. We'll explore how these can add value to your property and create additional income streams.
Yeah, it's going to be super informative.
So, until then, keep your eyes on those opportunities. And remember, every step you take today is a step towards financial security.
Take care, everyone.